Thanks, everyone, for being here this afternoon. We have a few topics to talk about. We'll talk about market point. The end of the quarter is just around the corner, so we have to think about what our clients would like to hear from us. So maybe I'll start with you, Randy. Any thoughts on what clients are concerned about, would like to hear about?
Sure. A lot of the conversations I think stem from just the reassurance of the right objectives for accounts. But as it relates to the market, I think there are a few things that are becoming more and more popular. Well, one, covering a lot of things is just understanding the market, and a lot of things we've already been talking about, the valuations and how it can rally this much. And for that matter, from day to day, we've seen volatility pick up again. So it adds to the confusion and certainly the outlook as well. So they're stemmed around that, but I think specifically, like for example, this morning I got a question about, well, as an investor, what does the Federal Reserve buying individual corporate bonds mean to us? So I thought it was a pretty good question, and it touches a lot of things, but I think again, their perspective is, as an investor, what does that mean? So that'd be something on the fixed income side to focus on. As we saw some stuff, added to the market earlier this week when they announced the individual bond purchasing, among all the other things they're doing to stabilize the environment, that certainly was well received by the market. And then it's starting to, as we would imagine, the politics side, the presidential election and the idea of what the outcomes might mean for the market. I read a piece recently that basically the opinion was whoever does win the White House has a good chance of having the influence on the Senate. And then for that matter, it seems, that certainly the potential for a blue wave from the Democratic Party could be a higher probability as we stand today. But we all know that that's going to change going forward. So those are the two main things. I mean, there's a lot of other questions, and certainly people wonder if they need to do something with their portfolios. But from an objective standpoint, but from a high level themes, I think those two were at the top of the list.
We use this as an opportunity to continue our effort that we try to do all the time with clients, but educate them on the advantages of staying true to your objective and long term. I think the quickness of the move down and then the recovery is a good example of, if you try to pick the bottom or pick the top, you're going to have a hard time doing that. So we could use this as an opportunity to emphasize that by explaining the movements and what happened over the course of the quarter and how quickly it happened, but then just reiterate the fact that for most investors who have a longer term objective, this is just going to be a short-term blip in kind of their long-term experience, and staying to that objective, is ultimately what's going to be the best recommendation for most of our clients.
That would be a good message for sure in the market point.
I know, Christine, you've been instrumental really in putting together what we call an education packet here. So maybe from your perspective, anything that was really hot this particular quarter that we should think about as we think about market point?
Yeah, kind of like we just talked about, there are sections now focusing on long-term investing as well as market volatility. Slide 34 focuses on market volatility and a lot of clients trying to time the market. And so this is a good slide that shows the dangers of that and the potential that you miss out on some really good gains when you're trying to time the market.
I know I've seen something before that shows like the return after a big market down move is tend to be some of the greatest up moves as well. And this is kind of capturing a summary of that, where if you miss some of those days, you can really hurt your longer term returns. But do we have a chart that specifically covers that? Oh, right here. There we go. So that could be something that we want to bring to when we're covering the fact that, the movements was extreme, but maybe doesn't impact your longer term outlook if you just stayed invested. Trying to incorporate some of this in there as well could be useful.
Brett, I know you have also been helpful in helping clients, helping relationship managers to address short-term concerns that clients may have. So you've been sending in daily emails to our relationship managers. So you want to talk a little bit about that and talk about some of the feedback you may have received and from our clients and relationship managers?
Sure. So like Jan said, it's a daily email that goes out that goes over a couple different sections. The first one is performance. So it's kind of like a real time, everyday update of how portfolios are performing over different time periods and in real time. Not that we like to focus on short-term performance, but given the most recent market pullback, it was actually kind of crazy to see how quickly markets rebounded and the impact it had on our portfolio returns. Just another real life example of staying the course and not taking money out at the bottom and things of that nature. And then the next section is just some portfolio talking points. So it's just given our clients and relationship managers updates on what we're thinking with portfolios and any changes that we might be doing. And then there's a short market update, daily market update that's in there that just kind of gives you a small recap of what happened in the market that day and any news that drove the markets, whether it's coronavirus or the Federal Reserve or anything like that. And then the last section is kind of more behavioral talking points, general talking points, I guess, that kind of go over some long-term market characteristic stuff that I know Randy's alluded to in the past. And just some kind of good points that we've gathered from some of our resources that we utilize, how to talk to clients and answer some of the concerns that they might have during this volatility.
Yeah, I think it's a great piece and been appreciated. So we should probably take a look at that as well. Try to see if there's anything in there that could help us in the crafting of Market Point this quarter. So think about the first portion of Market Point as being more section where we cover the macroeconomic environment and they're based on what we just talked about. And you guys tell me if we're on the right track here. But I think certainly a section on the virus and the impact that the virus has had on the economy, and maybe thinking more long-term, the long-term impact that some of the changes we were forced to go through may have on the U.S. economy and the world economy going forward. So I don't think we're going to be looking at as a society as much at the daily cases, but maybe paying more attention to the ability of the healthcare system to handle the number of cases that are out there. So an update on the coronavirus, and I think, Randy, you alluded to that. I think we should probably be thinking about politics. Now it's coming up. Interestingly, we tend to hear about politics months and months and months in advance of an election, but this time around, I think people have been focused on other things, understandably. But is going to be ramping up here in the months to come. So I think we should probably talk about that, and again, what that means for our client portfolios going forward. So this is what I'm thinking, kind of to start Market Point. After the first section on the macroeconomic environment, we typically talk about the equity markets. So Ryan, do you have any thoughts there on what you've been thinking about, including in the Market Point?
Yeah, we talked about valuations a little bit, and I think, obviously markets have gone up a lot. I think, global stocks are up like 34% since the trough on March 23rd, and U.S. stocks, or say the S&P 500 is up even more than that. So the price and the price to earnings ratio has really caused those valuations to go up. But what I think is interesting is the EPS, the earnings per share part, and the denominator there is, I think, more important, because one of the things I want to talk about is, if we look at, it's a pretty fragile number. I mean, it feels like analysts are, forecasting their earnings expectations 12 months out, 2021, 2022, but you don't see many companies these days providing an outlook or guidance that analysts oftentimes rely on for their outlooks, because these companies have so much uncertainty in their businesses right now, so they don't want to take a stab at what it could look like down the road. But I think what's probably going to happen is you're going to see profitability is going to take a pretty big hit. I mean, you think about things like, what kind of costs are these companies going to have to pay for coronavirus measures to protect employees and to protect customers, and all these different things we've seen put into place all over the place, but what more they need to do to get people back to work and to get demand higher and people comfortable to buy products and use their services. So I think that's a huge challenge, I think, is to understanding what the higher operating costs could be for some of these companies. Also, like, for a long time, many years now, we've seen companies buying back their shares of their outstanding shares so they can kind of prop up their earnings per share. And so you've seen a lot of money going into that, which kind of pumps up, that EPS. And if they're not spending that money on that because either, they want to probably protect that money, save it, use it for these difficult times in case that we have another, situation where things get worse and they want to have more cash on the balance sheet, they might not buy as much, their shares back. And so that's not going to prop up earnings like it once did. In fact, you could even see companies maybe issuing stock rather than buying it back, actually issuing it because maybe they want to, maybe they have a lot of debt on their balance sheets already. So maybe going out and getting more debt, even if interest rates are pretty low now, but again, depending on the quality of their balance sheet, maybe they can't get interest rates that are that low. And so they're stressed out on their amount of leverage they have. And so they're going to issue shares in the market, public markets. And so that could dilute their earnings per share. So that could hurt kind of profitability. And then as Randy was talking about earlier, depending on what happens with the election in November, if we have a change in the administration, and you could see that corporate tax rate go back to what it was prior to what the current administration did with tax rates a couple of years ago, which, the market responded very positively to. So perhaps it could respond, a corresponding negative move to that if we did see corporate tax rates go back up to what they were beforehand. So I think that I want to address about how fragile I feel like earnings are going forward, just so much uncertainty, but it feels like there's just too many levers here that could drive it down from where expectations are, that it's a big risk to where stock prices are right now.
Hey, Ryan, on the uncertainty part, I think you had mentioned a couple of weeks ago the fact that analyst expectations are kind of all over the place because we really don't know what earnings are going to be, especially in the near term quarters, but even when they project out a year or so. Is that something that maybe we could or should incorporate into the context of the challenges of trying to use valuations in this current market? The traditional measures may show that they're high, but there's really that uncertainty and we don't really know what the earnings are going to be because of that wide dispersion. So perhaps quantifying some of that, comparing that to what we typically see could be useful.
Yep. No, that's a great point. It's interesting even looking at like 2020 earnings expectations, they declined like 30% from the beginning of the year to where they're at now, just because of all the negativity from the virus. But if you look at, say, 2021, it's gone down less. So let's say I think it's like 16 or 17% from, I think, February 1st until now. 2021 earnings expectations are only down about 16% compared to 29 for 2020. Then you look at 2022, they're down about 6.5% down. So it's just like, you'd almost think that you would see much bigger chunks come down. And I think that really reflects how much uncertainty is there because analysts, haven't really taken earnings down very much compared to what they were. And should it be down more? Perhaps because of the level of uncertainty now, but maybe things can get back to where they were before all this started. And so maybe it shouldn't be taking them down as much. But that's the point, is that there's so much uncertainty around it that valuations, traditional method, as you say, just become much more difficult.
On the flip side, though, have we heard anything about the fact that maybe there are a lot of companies out there that are realizing that with technology, they can do a lot more with a lot less? And today, I would think that it would not be a good time for a CEO to go out there and say that as a result of that, we're going to lay off permanently a bunch of people, when everybody, including the government, is trying to kind of maintain the level of employment, if not, allow people to return back to work. So Have you guys heard anything about that? I have to think that's going to be a positive long-term corporate profitability. Obviously, it may vary from one industry to the next, but I have to think that companies have been shocked by how well they can operate from with their employees basically being at home and not in airplanes, not in hotel rooms, and not in high-riser in very expensive cities.
I haven't heard anything that's over-encompassing, the entire industry or certain industries, but I do recall hearing specific companies coming out and saying they're going to allow all their employees to work from home for indefinitely if they so choose. So that certainly changes a cost dynamic at the company level. Perhaps they need to spend some money to facilitate some technology to those employees to work from home, but they're not going to maybe need to spend as much on the office space and other items. That does create a bunch of uncertainty and could be to the positive of valuations from that standpoint.
I was just going to say, I think we were early in identifying technology as a key sector that we want to hold for our clients, because it's a secular grower sector of the economy. But I'm just wondering if there's something that eventually will come out of this, which will be, again, beneficial for corporate profitability and valuations.
I haven't read, like Brandon, I don't know if I've read a lot about that or seen much on it, but, it's an interesting thought. I do wonder if that's maybe a trend that maybe if it does kind of come to fruition and we do see some corporate expenses being taken out from the ability for people to, whether that's work from home or work differently than they were before, how soon that can be reflected into profitability and the bottom line for companies. And perhaps that's something that plays out more of a longer term trend. So, as we look at where we think the markets are headed next on the equity side, it just makes me wonder how soon that we'd be reflected in these numbers now, or, how quickly could it offset some other of the factors that cause me concern. But I think to the point, you're just talking about technology. I mean, we've seen technology as a sector do really, really well for a very long time. What does all of this over the last few months do to that sector? Does it create more investment interest because perhaps even more emphasis on innovation and technology than even 6 months ago? It's just interesting how we look at that within our portfolios about how much to allocate to technology. And, even though we've seen some certain valuations there look a little rich, is it something that maybe it continues to be a winner for a very long time?
Could we talk about that a little bit in addressing some of the changes we've made in the quarter, increasing our allocation to U.S., which is generally a higher allocation to technology, and then also small cap growth in particular that has higher allocations to technology. I think it'd be important to just recap the change we made, why we made it, and that will be a component of it.
Yeah, that's good. I can throw that in.
Oh, did you have any else in mind, Ryan?
I'll probably have a couple more things, but I think really it's going to be focused around the impact this has had on earnings, the uncertainty around it, valuations, things like that, to kind of understand what's the right value of the market maybe today, what levels could trigger us to make moves, whether it's to increase our allocation equities, or maybe, as you mentioned earlier, is there a level here based on our analysis where maybe we think valuations are so high that maybe we want to trim back our allocation equities. So I think those are the areas that I'll focus on in Market Point.
And I know I'm going to show a slide here that some of you have seen before, but I think it's a very interesting one. And we talk a lot about valuations, and this chart is actually asking professional money managers their thoughts on valuations, and a record 78% say the stock market is overvalued. Going back 20 plus years, we've never seen that kind of number. So internally, we're talking about valuations being high, but I think outside our own world, when other money managers are looking at valuations, they also think that valuations are quite high. So again, maybe a sign for us to continue to be a little cautious here. So I thought I would just show this. I think it's an interesting one.
Yeah, it's a good slide.
Steve, I'll ask you to also share your thoughts here on the fixed income section of Market Point and what you're thinking.
Yeah, I mean, one of the things that has maybe contributed to equity valuations becoming so rich is the Fed. And Randy alluded to it earlier, but clients are wondering what the Fed support means for our portfolios. So I was planning on hitting on some of what the Fed has been doing. I usually touch on the Fed and market point, and there's certainly a lot to talk about this quarter as well. But if it wasn't already kind of obvious that the Fed is going to continue to act as a tailwind for riskier assets. At last meeting, Chairman Powell made it pretty clear. He was specifically asked about bubbles in financial markets and riskier assets. And the response from him was really focusing on, the millions of people that are unemployed. And he kind of implied that it wouldn't be a proper use of the Fed's duties if they stopped providing monetary stimulus just because, asset prices were getting stretched or overvalued. And the time to worry about deficits really that have a lot of people have been worried about is not now. It's when the unemployment rate's low, when we have kind of stronger economic growth. So I was going to hit on some of the specifics that they've been done, whether it's the primary corporate credit facility or the secondary corporate credit facility and the amount of corporate bonds that they're buying and how that has supported, credit markets and maybe risk assets in general and how that has, impacted our portfolios and what we've done throughout the quarter based on that as well.
Of all the surprises we've had this past 3 months, I think to me this is the biggest one in the sense that programs are announced and then quickly after they announce they are tweaked, adjusted, and always in the direction of providing more and more. So I think most people have underestimated not only the power of the Fed, but their willingness really to help. I think the question about the debt levels will come back. I think we've tried to address that in the past. I don't think we have all the answers to that, and nobody does. But it's interesting to see that for the first time I can remember, you have really dedicated, committed central banks and governments doing and trying everything they can to cushion the downside here. So I think we have to spend some time on that as well, for sure.
Steve, would highlighting the Fed dot plot or the FOMC member expectations of where benchmark rates would be out in the future. I think there's been some headlines recently about them saying they're not going to raise rates again for a few years, and I think it was based off of what those expectations were, which isn't necessarily a prediction of the group as a whole, but maybe individual opinions. But does that play into what's happening in interest rate markets, and would that be something that'd be worth showing?
Yeah, it's interesting you say that because that is another topic that I was going to cover in Market Point. We always want to be looking forward, right? And what is the Fed funds going to look like going forward? So that is a topic I was going to hit on, the outlook for the Fed funds rate. So they're likely to keep rates at the zero bound out to 2022. That's what's priced in right now. I think investors may have been looking for a little bit more guidance at the last meeting on future rates, something like along the lines of what was used during the last zero bound episode during the last GFC, whether it's an unemployment rate target or some specific inflation target. They didn't necessarily do that. In my mind, they didn't have to have any kind of implicit target because the market, based on Fed funds futures, which are kind of market expectations for the Fed funds rate, are also showing, no interest rate hikes out to 2022. So I think the market has certainly bought into the Fed's, lower for longer interest rates. And that has certainly had an effect on, treasury markets, interest rates in general throughout multiple sectors of fixed income, whether it's mortgage-backed securities, corporate bonds, but it has had a outsized effect, I would say, on treasury yields and brought them down to historic all-time lows. So that's certainly a topic that will be, included in this market point.
I know from time to time we've talked about return expectations, and we're just talking about interest rates being really low here and the markets believing in the Fed. obviously from a fixed income standpoint, that also means that return expectations should probably be lower going forward. And given where valuations are, we talk about valuations in equity markets, expectations also for returns there may be lower than what they've been historically. So always a difficult message to communicate to clients, not a fun one to communicate, but I think we have to continue to manage expectations when we can, because the reality of it is just that forward-looking returns will be certainly less than they have been historically, unless we go through the zero bound when it comes to interest rates and we go negative. But I think the Fed has been pretty clear that this is not something that they're going to try first. So.
And maybe it's a good opportunity to hit on the benefits of a globally diversified portfolio. The nice thing on the fixed income side is fixed income securities in the different sectors of the bond market are a lot less correlated to each other in the stock market. And so we're able to, a diversified portfolio, enhance the yield and enhance the forward-looking returns besides just looking at the forward-looking returns of treasuries. There are certainly other areas of the market where we can get better yield and better returns. So maybe it's a good opportunity to hit on that again as well.
Yeah, good point.
That would fall under the reasons why the changes we made last month. That would coincide with that pretty well.
Exactly, yep.
Maybe it's not significant enough yet or call it a trend, but the one benefit, even though the market's really high and valuations are high, is in the last, call it 3 weeks or more, we've seen that the idea of the sector rotation or just rotation of the market, the small caps that have been beat up so bad are getting attention. So something I've been talking a little bit about and how healthy it is not to continue to see the same large stocks lead the market.
All right. Any other thoughts from anyone?
Well, I just saw an interesting piece on the market leadership of some of the biggest names in the S&P that I got to get over to Ryan because it really did a good job illustrating on 1 year, 3 year, and 5 year returns of a few individual stocks relative to the S&P, which actually has lagged a lot of other markets. So I'll get that over to you because I think it did a good job illustrating that point.
I actually authored that article, so I already have it, so you don't need to send it to me, but thanks.
Nice job, Ryan.
Thank you.
He's on top of things.
Yep.
Before we conclude, I forgot to cover some of the slides related to the virus, so I'm going to do that quickly, but good conversation. Thanks for your input. I think I have 5 or 6 slides related to that. So as of late, obviously, we've heard a little bit more about new waves of infection, especially in the South and the West Coast as economies are reopening. There was an interesting study done recently showing the impact of weather. I mean, all along, people have believed that coronaviruses tend to not live as long or not transmit as well in warmer climate, more humid climate. And they were saying that it is true up to a certain point. When you go beyond that point, people are just too hot, so they don't wear their mask anymore, and they're looking for air conditioning, so they're staying inside more. I thought that was very interesting as we get through the summer months here. We're seeing, obviously, some of these states dealing with much warmer weather, and as a result of that, maybe that's one of the reasons we're seeing more infections. Now, the other point to remember as the media will report on daily new cases is the fact that we are testing more, all countries are testing more. And although it's not a linear relationship, there's a relationship between the number of tests and obviously the number of reported cases. So when we're looking at the data today, looking at the data like a month ago, 2 months ago, we're not really comparing apples to apples when we're just looking at the number of new daily cases because there's simply more testing. One important piece that is often, I think, missed in the media is the fact that in the US, the number of cases, the number of tests has increased, but the number of people that have tested positive has steadily declined. Although, if you look at the last month or so, it's been around 5% or so. So I just wanted to mention this because when we started our conversation, most of the experts were saying, if we can run like 3 million tests a week, I think we're going to be in pretty good shape in identifying kind of early on some of the new cases. And when you look at this here, we're showing number of tests per day. Multiply that number by 7, we're there 3 million tests a week. So from a testing capability standpoint, I think we've gone a long way now. And the trend here, although we've seen anecdotal reports that hospitalization are rising in certain states, generally speaking, the trend has been mostly down. I think the focus has shifted now, whereby we will allow our economies to continue to operate normally as long as the healthcare system is not overwhelmed. And what is not shown here is that obviously the healthcare system is better equipped today than it was 3 months ago to handle a higher number of cases. Another point that I think is important is what's mentioned in the bottom paragraph here, which is the fact that a lot of the new cases are apparently younger people that have themselves decided to kind of resume their normal lives. And as a result of that, the number of people being hospitalized is less because these people are usually going to go through the virus, no problem, right? And also the point that these are the people that were in protests we've seen recently, and the people that are most vulnerable know they are most vulnerable, so they're not exposing themselves to the virus. So as a result of that, the number of people being hospitalized should continue to decline unless we see really a significant spike in the number of cases. So I think it forces me and forces all of us to rethink about some of the reports that are being circulated and what exactly it means when it comes to the economy and markets in general. And quickly on treatments and vaccine, again, I'm taking some of the information from the Goldman Sachs call that I took earlier this week. From a treatment standpoint, they believe that we're going to get a number of different solutions either before or at the same time as we're getting a vaccine. And when it comes to the vaccine, they believe that there are going to be probably multiple vaccines across the world. The two most promising ones, the one from Moderna and the Oxford University. And there were a number of specialists on the call basically saying that they are optimistic that we're going to get a vaccine for frontline workers, the healthcare workers, by the end of the year. There's hope that we could get one for mass distribution for the population, more likely middle part of 2021. I just wanted to share that with all of you. Things continue to evolve on that front. And as I review also the indicator tables, I think I'm going to start to try to incorporate some of these new variables that I think are going to be more relevant going forward in determining, again, what the path of economic growth looks like going forward. All right, so great conversation again, and talk to you all soon. Thank you.